Welcome. This is volume 1 of the Intermediate Accounting KiesoVolume text, and we're talking about revenue recognition. And so this is chapter 6 of the text. The learning objectives are listed here, talking about recording selling transactions and some of the things we need to know about them. Talk about 5 steps in the revenue recognition process. A fairly new direction for revenue recognition is a contract-based approach, and so we'll talk about identifying the contract and the steps that are involved there. We'll talk about separate performance obligations, determining the price, the transaction price of the I guess the journal entry we're going to record. Then we're going to allocate the transaction price to the separate performance obligations within the contract. All of these are steps within the revenue recognition process. We'll understand recognizing revenue when the company has satisfied the obligation within the contract. So that's fairly straightforward. Then we'll talk about the earnings approach, which is more the ASPE and the historical GAAP approach in Canada. And we'll talk about the sort of the major criteria for revenue recognition. We'll talk about some other issues, talk about presentation and disclosure with regard to revenue, and then look at a few differences between IFRS and ASPE and some potential changes which are happening in the IASB and FASB pontifications, and that should be enough. The relevant standards are listed here, kind of small. The revenue recognition and measurement standard within ASPE is section 3400. For international accounting standards, number 11 and number 18. There are some special revenue considerations for biological assets, basically your herds of cattle and that sort of thing. And of course that doesn't apply to ASPE, but IAS 41 deals with those issues in international accounting standards. IFRS 15 deals with revenue from contracts with customers. It was issued in May 2014, and it applies to annual reporting periods on or after January 1st, so that's beginning on or after January the 1st of this year, 2018, when I'm making this recording. So the basic approach is shown here for the revenue recognition chapter. So we're going to look at the earnings process, look at the concept of value added in particular, and so if we look at illustration 6-1 in your textbook, there's a few different earnings processes listed there. We talk about merchandising, where we receive the order from suppliers, receive the goods, then display them in the store, we sell them, and then collect on account, and that's the cash cycle. So we order our inventory from our suppliers, we receive the goods and display them in the store, advertise them, and then collect cash. Agriculture, somewhat more of a manufacturing process. We assemble the inputs, planting and fertilizing, weed treatment, then we harvest and store, and then deliver the product to whatever facility is available. In Canada, there's grain marketing boards and that sort of thing that take care of that portion. And so you deliver the goods to the customer and then receive the cash upon payment. Service industries are somewhat different. We start by assembling the necessary resources, then promotion of our services, sign a contract, then perform the service, bill the client, and collect the cash. And that's somewhat similar to the contract-based approach, which we'll talk about in today's discussion. So that's somewhat of the economics of sales transactions, as we've shown here in our little acrostic, our flow of the PowerPoint slides. So understanding the nature of sales transactions, you really need to understand all of the components of the sales transaction to understand when they've completed the necessary work and when they will be collecting cash from their customers. So some key distinctions within the economics of sales transactions would be identifying what is necessary to understand the type of business to determine how to account for its sales transactions. So it's important that you understand what kind of business you're in. We need to outline some of the complexities and issues in revenue recognition, including such things as sales of goods versus sales of services, barter transactions, so exchanges of goods for other goods, or exchanges for services of goods for services, or services for goods, or services for services. So rather than a cash exchange, we're exchanging a bartered exchange value of some sort. We'll have to talk about the concept of fair value, because we don't actually have an objective value paid in cash in such a situation. We'll talk about concessionary terms within sales agreements. So we'll talk about what that means as well. We'll talk about some legal issues within contract law in terms of when a sale transaction actually happens. Within recognition and measurement, we'll talk about the asset-liability approach, or the contract-based approach, which is a fairly new approach to recognizing revenue, as we noted for fiscal years beginning on or after January the 1st of this year, 2018. So that is the newer approach. That's the one that they use in IFRS as of this year. It's compared to or contrasted to the earnings-based approach, which was the older approach. And so in a contract-based approach, we focus on the contractual rights and obligations created by the sales contracts, whereas an earnings approach focuses on the earnings process and how the company actually adds value for its customers. ASPE, of course, uses the earnings approach, the historical GAAP approach. It's primarily an income statement-focused approach, and under that earnings approach, the revenues for sales of goods and related costs are recognized when all of the following conditions are met. The risks and rewards of ownership are transferred to the customer, often called completion. So you've completed the process. Secondly, the vendor has no continuing involvement in nor effective control over the goods sold. So the control over the use of the assets has been transferred from the vendor to the purchaser. Also, costs and revenues can be measured reliably, and also collectability is probable. So the ideas of risk and rewards of ownership being transferred, and the idea that the vendor has no continuing claim over the goods sold or control over the goods sold, that's the idea that we used to refer to as completion. Costs and revenues measured reliably, you could refer to that as measurement or as calculability if you like. Collectability is the ability that we have to ensure that we will receive the cash for the transaction. So that's all of those pieces of the revenue recognition process have to be met for us to recognize the revenue. And when we do, we recognize the revenue, and of course we match the costs against it. So it's important that we be able to match all of the costs, which means that not only must the revenues be measured reliably, the costs must be measured reliably as well. Appendix 6A, which we'll briefly touch on, refers to long-term contracts, and so it contrasts the percentage of completion method, which is an earnings approach, with the completed contract method, which is the major alternative to the percentage of completion method. If you'd like to know a little bit more about the journal entries that are necessary for the percentage of completion method for a long-term contract, so percentage of completion method is used for contracts which extend beyond 1 year, and so the question is how much of the job has been completed, how much of the revenue has been earned within this period. And so the journal entries to accomplish that with the percentage of completion method are listed in illustration 6A-1 to 6A-5 in the textbook. So take a look at it there. Essentially, gross profit is recognized periodically based on the percentage of the job that's complete, rather than when the entire job is completed, because that would mean that we would have to wait until the end of the project, which is sometimes a couple of years longer, maybe more than that, before we can actually record the profit that we're earning. And of course, we're earning, we're entitled to some interim payments, and we're also entitled to recognize some of the revenue due to the work that we've done during the period. The method, the percentage of completion method, should be used essentially when estimates of cost to complete and the extent of progress towards completion are reasonably determinable. So you need to be able to determine how much costs have been expended and how much expected future costs will be expended, and some measure of extent of the progress towards the completion. So if there are measurable requirements along the way, we can use those as sort of the deliverable components to measure the progress. Also, the extent of progress towards the completion is often measured by a cost method. So you calculate the percentage of costs expended, and that would represent the percentage of completion. So you would recognize the percentage of gross profit as well. The completed contract method is also an earnings approach, and in a completed contract method, the gross profit isn't recognized until a complete contract is finished, so the contract is completed. That's not acceptable under IFRS. You must use a percentage of completion method. Of course, the difficulty of measurement would regard the extent of progress towards completion, and that might be a difficult thing to do. So illustration 6A-10 from the text provides a numerical example of the journal entries made when you're using the completed contract method. So if you're interested in a business or industry which tends to have those long-term contracts, it might be worthwhile exploring that. In the accounting for long-term contracts, an additional complexity may arise when the outcome of the contract is not determinable. So this might occur, for example, at the beginning of the contract, where it might be difficult to estimate cost to completion, and so therefore it's hard to demonstrate when the percentage, what percentage is complete over time. So in this case, as noted earlier, recoverable revenues equal to costs incurred would be recognized under IFRS, but under ASPE, if the outcome is not determinable, the accounting would just default to the completed contract method. Other IFRS and ASPE comparisons will take place at the end of the PowerPoint presentation. Illustration 6-34 in the text, though, presents a comparison chart comparing IFRS and ASPE related to revenue recognition, and so you can take a look at that and develop your understanding of the differences and similarities between international standards and the ASPE standards. So, moving into, let's take a quick scan of the outline of the PowerPoint. So we've talked about the nature of sales transactions, what exactly that means. We'll talk about the different approaches, the asset liability approach being the new one, and some more of a balance sheet approach. And we'll talk about how we actually measure the key steps in that process. We'll talk about other revenue recognition issues, such as the right of return of assets. Have you really sold it if they have the right to give it back to you? Repurchase agreements, bill and hold arrangements, principal agent relationships, consignments, warranties, non-refundable upfront fees, and other revenue recognition issues. There are some fairly complex issues in recognizing revenue, so we'll talk about those as we go along. Presentation on disclosure includes footnote disclosure, or notes to the financial statements. Footnote is the term that they use south of the border. In general, Canada refers to them as notes to the financial statements. We'll talk about what's required disclosure with regard to revenue recognition. Of course, obviously the policy would be required, but also some other details would be disclosed as well. And that should give us a pretty good summary of where we're headed. Understanding sales transactions. It's essential that we understand the type of business that an entity is engaged in order to determine how to accurately or correctly account for its sales transactions. The general rule is the risks and rewards of ownership must pass, and when the risks and rewards of ownership have passed, then we have earned the revenues. So that's kind of the major idea behind recognizing revenue. We also need to consider, are goods or services being sold? Goods are tangible assets, and possession of control of the goods is easier to define. Services, not so much. Combinations of goods and services even makes it even more complicated as to when to recognize the revenue. So, for example, the sale of a product with a warranty. The product, of course, is goods. The warranty would be a later service. So, those are kind of the key questions that are related to understanding sales transactions. It can be a fairly complex topic, and so we'll talk about the ways of getting through that complexity. So a couple of key questions as they note in the slide. what is being given up and what is being received, what is actually transacted by the two sides of the transaction. Okay, now another question that comes up is the issue of what exactly is being sold. And so sales transactions may involve goods and services or both. So the key components of the accounting would be different in different situations. Sales of goods, there are fairly obvious signals as to when a transaction results in control, or when we've completed the transaction, when we've shipped the goods to our purchaser. Then in general that would be enough evidence to say that we've completed our revenue recognition process. Although, as we'll see a little bit later, if there is a right to resale or a right to return those assets, then it's not quite as clear. In general, the transfer of legal title is a good indicator of the fact that you've transferred the risks and rewards of ownership. Sales of services, the legal title to the services, for example, the legal title to use the software in a software consulting or computer consulting engagement. When you have the right to use the software, that's indication that the risk and rewards of ownership have been transferred to you. In general, for services, possession isn't relevant because it's hard to determine what possession means in terms of services. And there can be a number of different ways of bundling them together. And so one of the issues of the asset liability method of recognizing revenue is to parse them out and determine which is which. Barter transactions are tricky as well. You need to understand the concept of fair value in arm's length transactions. So barter transactions are transactions where little or no monetary assets are received as consideration when goods or services are sold. And as a general rule, the transaction should be treated as a sale and should be recorded at the fair value of the assets given up, unless the value of the assets or services received is more clearly determinable. So if there's a better measure, we should use the best measure. The more liquid market, the more actively traded market would generally be the one which is more clearly determinable. If the transaction lacks commercial substance, so there's no significant change in the timing, amount, or riskiness of the future cash flows, then it really just means that the transaction is a bona fide or legitimate purchase and sale, and the entity has entered into the transaction for business purposes, exchanging one type of asset or service for a different type of asset or service. So book values, in that case, would be used to record the exchange asset. In terms of what is being received, the idea here is business transactions are an exchange of one thing for another, and so the journal entry process, the double entry bookkeeping system, really depends heavily on that idea. So you're giving up something in order to get something else. So usually there's an obvious exchange of goods or services for one another. The easy thing to do is if we can identify a cash or cash equivalent part of the transaction, then that's easy to record in most cases. It gets a little trickier when it fits into the barter category or non-monetary exchanges. So the key idea is the fair value of what is given up and the fair value of what's received back. Concessionary terms. The idea here is that we need to identify whether such concessionary terms actually exist. And so concessionary terms are things which adjust or fine-tune or provide more detail about what your obligations are under the contract. And so concessionary terms would exist perhaps when it may happen when one party is in a better bargaining position than another, and it must be determined if the concession significantly affects when revenue would otherwise be recognized. So it may lead to uncertainty in measurement, which is one of the key components of the old income statement-based revenue recognition criteria. Note that concessionary terms are terms negotiated by a party to the contract that are more favorable than normal. So concessionary or abnormal terms would be terms which may create additional obligations or may reflect the fact that the risks and rewards of control has not yet passed to the customer. And so these situations must be carefully analyzed as they create additional recognition and measurement uncertainty. And they may indicate that no sale has in fact taken place. So you need to determine them. Some examples are shown in the slide. Lenient return or payment policy, selling price being deeply discounted for the customer, kind of the Walmart situation. Continued involvement by the seller in the process after the goods or services have been delivered. Particularly gracious credit policy. Bill and hold transactions where you bill the customer and then you're required to hold those goods in your own warehouse until the customer picks them up, so you can't sell them to somebody else. Any other kinds of extra requirements would have to be considered carefully. Legal issues with regard to sales transactions. Legal issues in contract law have a bearing on our determination of revenue recognition. So when an entity sells something, both the entity and the customer enter into a contract, and regardless of whether the contract is written or verbal, the important thing is that two parties have promised to exchange assets, and this creates a contract. There's a promissory, or the seller, a promisee, the customer, and an agreement between them. Thus, the act of entering into a sales agreement creates legal rights and obligations. In addition, the contract establishes the point in time when legal title passes. So entitlement and ownership under law is when legal title passes. So when the customer takes physical possession of the goods, if they take it straight away, then legal title would normally pass at this point. If the goods are shipped, the point at which legal title passes is often indicated by the shipping terms. So remember the terms FOB, free on board shipping point, and free on board destination. So FOB shipping point means title passes at the point of shipment. So when it's off our dock onto the customer's truck at the shipping point, that would be the customer's asset at that point. FOB destination usually means it's on our truck until we deliver it to the customer's dock at the other end. So title would pass when the asset is actually received by the customer. So FOB shipping point and FOB destination are key terms indicating when the title passes. Other laws may apply even if they're not stated in the contract. So for example, environmental laws and environmental obligations would bear on the transaction as well. So this may create an obligation that should be recognized on the statement of financial position. So for example, if you have a contract to mine oil sands in northern Alberta, you also have an obligation to fulfill the environmental constraints created by legal statute by the Alberta and federal government. Sales transactions, recognition of revenue, so revenue recognition and measurement. There are two different approaches to recognizing revenue, as we've stated: the asset-liability approach or contract-based approach, and the earnings approach. The contract-based approach is widely applicable to a number of different areas, so we'll talk about it in quite a few situations over the next couple of courses here, because it's an important and fairly major change in the way we view contracts for revenue recognition. So, key definition is shown on the slide. Revenue or sales is an inflow of economic benefits arising from the ordinary activities of the business. Of course, that's to exclude gains and losses on sales. So if you're a farmer, your tractor is your production equipment, and so selling it would not be part of your ordinary business. But if you're a tractor dealer, selling a tractor is just part of your ordinary inventory transactions. Now we'll spend quite a bit of time here with the asset liability approach. It is a fairly new idea, and it has quite a bit of detail that we need to work through. So there are some key components as listed on this slide. The new IFRS standard is called Revenue from Contracts with Customers, and it adopts this asset liability approach as the basis for revenue recognition. The asset liability approach recognizes and measures revenue based on changes in assets and liabilities. The International Accounting Standards Board decided that focusing on the recognition and measurement of assets and liabilities and changes in those assets or liabilities over the life of the contract brings more discipline to the measurement of revenue than the earned and realized criteria in prior IFRS standards. So ASPE still follows the earnings approach, which is the earned and realized idea referred to a moment ago. And companies account for revenue based on the asset or liability arising from contracts with customers. So a liability represents an obligation that you have. Companies analyze contracts with customers, and the contracts indicate the terms of the transaction, providing the measurement of the consideration of the contract. Consideration is what you're paying or what you're giving up in response to what you get from the other side. It specifies the promises that must be met by each party. So the contract is kind of the key document that we look at to support the asset liability approach of recognizing revenue. The new standard first identifies the key objectives of revenue recognition, and so the key objective is listed here: to recognize revenue, to depict the transfer of goods or services to customers in an amount that reflects the consideration that the company receives or expects to receive in exchange for these goods or services. So that's the key definition that we'll keep in mind throughout the discussion. Now there's a 5-step process that we use to identify that. So first of all, we begin by identifying the contract. Then we split the contract into particular performance obligations or liabilities in the contract. We determine the transaction price, allocate the price to the separate performance obligations, and then recognize the revenue when the performance obligation has been satisfied. So the revenue recognition principle stated at the end of the slide. We recognize revenue in the accounting period when the performance obligation is satisfied. All right, so the 5-step process begins as shown here. We identify the contract. The contract is the agreement that is signed between the two parties. It creates enforceable rights and obligations. For example, Boeing would sign a contract to deliver airplanes to WestJet. WestJet releases a lot of their planes, but let's imagine that Boeing has agreed, or WestJet has actually agreed to buy planes. Although I suppose the terms of the lease contract would actually still fit the description here. Boeing signed a contract to lease airplanes to WestJet, and so they would deliver them for their use. That would still fit, I suppose. Then identify the separate performance obligations in the contract. So in this case, Boeing has the key performance obligation to deliver airplanes. So it's an actual airplane that has to be delivered, and it's fairly obvious when that happens. If Boeing also agreed to maintain the planes, then there would be a subsequent service obligation to go with the goods delivered in the form of airplanes. Then we need to determine the transaction price, and the transaction price is the amount of consideration that the company expects to receive. It may be stated as a price in the contract. It may be contingent on some future event. There's a number of different ways that we can introduce some complexity into the idea of the transaction price. But in this case, Boeing has agreed to deliver airplanes, and WestJet has agreed to pay $100 million. Then fourth, we allocate the transaction price to the separate performance obligations, and there's only one here. So when we have delivered the airplanes, we are done. We being Boeing, of course. And then the 5th step is to recognize the revenue when the performance obligation is satisfied. So Boeing would recognize the revenue of $100 million for the sale of airplanes to WestJet when it delivers the airplanes to WestJet. So let's go into a little bit more detail identifying the contract with the customers. So key components are shown here. Contracts, of course, don't have to be in writing, although it's highly recommended that if you enter into a contract that you make it a written contract, because then it's much easier to determine exactly what the terms of the contract are. So contracts can be written, they can be oral, so we can agree the old handshake commitment would be an oral contract, or they can be an implied contract, implied by the relationship or by the statute. So that would be a case where you have an implied contract with the Alberta government to make sure you clean up your oil sands mining operation. So IFRS 15, recognizing the contract with the customer, would apply if the list of criteria on the left are met. If the list of criteria on the left are not met, you would disregard IFRS 15. And so if the contract is wholly unperformed, or if the party can unilaterally terminate the contract without compensation, then there's really not a contract in place, and so you would disregard IFRS 15. IFRS 15 would apply if the contract has commercial substance, which means that they're exchanging something of value for something else of value, so there's real consideration included. The parties to the contract have approved the contract, so there's some way of authorizing and committing the various parties to their respective obligations. And the company can identify the rights to the goods and services, so you can determine when title transfers, when you have the right or the obligation to deliver goods and services. That can be established. The company can identify the payment terms for the goods and services, so you know who's going to pay what and how. It's probable that the company will collect the consideration for which it will be entitled, so that's recognizing the old collectability criteria. If they can't pay for it due to bankruptcy or receivership or something like that, then you shouldn't be recognizing the revenue until you actually have a stronger indication of collectability. So, a contract would be an agreement between two parties that creates enforceable rights or obligations. A contract can be written, oral, or implied from customary business practice, so you can have an implied contract to continue under the same terms of a previous contract. Rental contracts, even if you come to the end of your lease, if you have a rental contract with a landlord, even though the contract is completed, the regulations would say that you have an implied contract because you continue to live there, to continue to pay rent at the same rate. And there are some constraints, or there are some regulations as to when rent can be changed and when the landlord can visit your premises. All those sorts of things would be implicit contracts under the statutory regulations. A company must apply the revenue guidance to a contract according to the following criteria as listed. So the contract has the things listed in the previous slide. So commercial substance, they've approved the contract, they can identify their rights, they can identify payment terms, and it's collectible. Illustration 6-4 in the textbook provides a summary of the criteria, and so I think that's where we took the previous slide. So that is found in your textbook, illustration 6-4. Now, in some cases, there are multiple contracts related to the transaction, and accounting for each contract may or may not occur depending on the circumstances. So a company needs to consider whether those multiple contracts fit the criteria for applying IFRS 15. A company should combine contracts and account for them as one contract if they constitute one set of obligations which are related. If a contract doesn't meet the criteria specified above, then revenue. If the contract doesn't meet the criteria specified above, then the revenue is recognized only when the performance obligation is satisfied and substantially all the consideration has actually been received. So in that case, you wait until you've actually gotten the cash before you record the revenue. Okay. Separate performance obligations. A performance obligation would be a promise in a contract to provide a product or service to a customer. So to determine whether a performance obligation exists, the company must provide a distinct product or service. So contracts with multiple distinct performance obligations represent bundled sales. So where goods or services are highly interrelated, then they're not separated out as distinct or separate performance obligations, and the whole contract is accounted for together. Identifying separate performance obligations. There's a number of different kinds of performance obligations depending on what kind of business. So we talked about making sure that you understand what the business actually does, how it actually creates value for its customers. So the standard idea, the sale of product from inventory, would recognize sales revenue, and that would be recognized when you actually delivered the goods, the product. And so your FOB shipping point or destination would be key items in identifying when that happened. Rendering a service, you would record fee or service revenue, and that would happen when you've done the services to the point where they're performed and billable. So we often talk in the computer consulting industry about deliverables, and when those deliverables are met, there are testing criteria, and when those testing criteria have been established as complete and those criteria are met, then you've met the deliverables and you can send the invoice and bill them for what you've done. Permitting use of an asset, so the rental idea. So revenue there would be called interest or rent or royalties, depending on what kind of an asset was being used. And that would be related to the period of time over which the right to use that asset is consumed. Sales of other assets other than inventory would generally be recorded as a gain or loss. Inventory being the ordinary business. Other assets, the farmer's tractor, would be a gain or loss on disposition. And the date of the sale or its distribution as part of the compensation for a new asset in a trade-in arrangement would recognize the gain or loss at that time. Okay. Get myself set here. Okay, so step number 3, determining the transaction price. The transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring the goods and services. So the transaction price in a contract is often easily determined because the customer agrees to pay a fixed amount to the company over a short period of time. In other contracts, the company must consider the potential other factors. The following factors would include variable consideration, so consideration which is dependent on some kind of a future recognition or realization of uncertainty. The time value of money. If there's a significant delay before the money is received, then the time value would recognize that the value of those payments is not as high as if they were received today. Any non-cash consideration, you would have to consider the fair value of those assets, and any consideration that is paid or payable to the customer as a result of certain criteria. So, for example, there may be a penalty for a late completion of the contract. Allocating the transaction price to separate performance obligations is step 4. Companies often have to allocate the transaction price to more than one performance obligation in a contract, and so if an allocation is required, the transaction price allocated to the various performance obligations is based on their relative fair values. The best measure of fair value is what the company could sell the goods or services for on a standalone basis, referred to as the standalone selling price. And so if you are in the business of selling these things regularly, you would probably be able to determine the standalone selling price quite easily. Sometimes the transaction price would include a discount or a contingent amount of consideration that relates entirely to one of the performance obligations in the contract. And so the proposals, the new standard proposals, specify that when a company should allocate the discount or a contingent consideration to one performance obligation rather than to all of the performance obligations in the contract. Of course, discount or contingent consideration would be a difficulty of measurement, and so if you can identify which particular performance obligation that contingent consideration is associated with, then all the other performance obligations can be, you can recognize the revenue from those other performance obligations without regard to the contingent price of this particular performance obligation, which gives rise to the contingent consideration. Recognizing revenue when the performance obligation is satisfied is step 5. A company satisfies its performance obligation when the customer obtains control of the goods or services. The customer controls the product or service when it has the ability to direct the use of and obtain substantially all the remaining benefits from the asset or service. So direct the use and get the benefits from the asset or service. Control also includes the customer's ability to prevent other companies from directing the use of or receiving the benefits of the asset or service. So it's not only that you can, it's that others can't. Note the amount of revenue that the company recognizes would be the amount allocated to the satisfied performance obligation, and other performance obligations may remain still outstanding. A performance obligation may be satisfied at a point in time, so typically for promises to transfer goods to a customer, or over time, typically for promises to transfer services to a customer. So services, over time, point in time usually applies for goods. For performance obligations satisfied over time, a company would select an appropriate measure of progress to determine how much revenue should be recognized as the performance obligation is satisfied. Indicators of control are listed on the slide. So these things would indicate that the company has the right of control, the ability to direct the use of and obtain substantial other remaining benefits from the asset. So you need to identify that your customer has those rights and that no one else has those rights in order to indicate that they've that you've performed your obligation. So a quick summary is shown here. This is taken from the textbook. Identifying the customer, each of the steps, identify the contract, identify the separate performance obligation, determine the transaction price, and allocate that transaction price to the performance obligations based on usually fair value, and then recognize the revenue when each performance obligation is completed. Now the earnings approach, the older approach, the one that which ASPE still uses, is primarily an income statement approach, and under the earnings approach, revenues for sales of goods and related costs are recognized when all of the following conditions are met. Risks and rewards of ownership are transferred. The vendor has no continuing involvement in nor effective control over the goods sold. Costs and revenues can be measured reliably, and collectibility is probable. We used to refer to these as the 3 C's: completion, collectibility, and calculability. So completion would be the first 2 points. Risk and rewards of ownership have been transferred, and there's no continuing involvement by the seller over the sold goods. The earnings process includes what a company does to add value to what they're selling. Often there's a critical event of some sort that signifies when the earnings process is substantially complete. So for instance, when a company sells goods, the critical event then would be the point of delivery. Transfer of risks and rewards of ownership is a core concept of the earnings approach. In determining at what point the risks and rewards of ownership are transferred in a sales transaction, it's important to look at who has possession of the goods and who has legal title. When an entity sells goods, there's often one main act or critical event in the earnings process that signals substantial completion or performance. And at this point, although some uncertainty still remains, its level is acceptable. The level of uncertainty is acceptable, and revenues can be recognized under the accrual accounting requirements. Some other revenue recognition issues are discussed in the textbook and in IFRS. They would include the right of return, and so we'll talk about these issues in sequence below. But the right to return says that if certain things are not acceptable, you can return the assets for a full or partial refund. Repurchase agreements are agreements to buy things back in the future, again under certain circumstances. Bill and hold, where you still have the assets on site, but you are allowed by the contract to charge the customer for them, or the customer is paid for them. Relations between principals and agents would be where someone else is selling things on your behalf. You need to recognize what the key performance obligations are in that situation to determine when the agent who is acting on your behalf as principal has performed the obligation. Consignments are when you have an agency relationship with someone else who is selling your product. So it's similar to principal-agent relationships, but consignments means that as long as the asset hasn't been sold to a third party, those assets are still yours, should be shown in the inventory, and you haven't performed your obligation to sell to the customer, because the customer is not your agent. The consignee is not your final customer. The person to whom they will sell it is your final customer. Warranty issues come up here and in the next course in 354. So warranty issues have a couple of different characters, and so we'll talk about those. We'll talk about non-refundable upfront fees. When have we actually earned that money? So, rights of return. Sales with rights of return have long been a challenge in the area of revenue recognition. So one example is if a customer is not satisfied with the product, the customer could be entitled to any combination of the following: a full or partial refund of any consideration paid, or a credit that can be applied against amounts owed or that will be owed to the seller, or another product in exchange. So if there is an expectation that items may be returned, you would make an estimate based on your experience and set that up as part of the measurement of the amount of revenue at the time of the initial transaction. So for example, the right of return in this situation, Venden Company sells 100 products, and they give their customer, Amaya, the right to return any unused product within 30 days and receive a full refund. At the end of the 30 days, they know there is no possibility of a full refund, but up until that point, they haven't actually delivered on their performance obligation in its entirety. So the cost of the product is $60, and they're selling for $100. To determine the transaction price, they have decided that the approach that is most predictive of the amount of consideration to which it will be entitled is the most likely amount. And so the most likely amount, Vanden estimates that 3 products will be returned out of the 100, so 3% of them will be returned. The cost of recovering the products will be immaterial, so the returned products are expected to be sold at a profit. And the question is, how would they record this sale? So companies would record the returned asset in a separate account from inventory to provide transparency. So the idea is that returned inventory would be separated out so you can manage that separately. Once again, it's a good idea to manage returns because that may be a very costly process. If the company is unable to estimate the level of returns with any reliability, it shouldn't report any revenue until the returns become completely predictive. So in the Vanden situation, when they transfer control of the products, they recognize the revenue of 9,700 of the items because they're expecting 3 of them to come back. A refund liability for $300, so that's a future obligation to provide a refund. And an asset of $180, which is the potentially returned inventory, so the cost of the goods which have been sold but are expected to be returned. So the asset is $180, and that gives them a recognition of the right to recover products from the customers on settling the refund liability. The refund liability is $300. Their estimated inventory returns is $180. So the transaction gets recorded as shown. We received cash of $10,000, of which we record $9,700 as sales revenue and $300 as sort of unearned revenue, refund liability in the future. They also recorded the cost of goods sold. $5,820 of the $6,000 of inventory they gave up represents the cost of the recognized sales revenue of $9,700, but the estimated inventory returns are $180, so it's not entirely an obligation. There's an obligation offset by the right to receive the inventory in return. So if they actually do receive a return, they would reduce the refund liability, and the estimated inventory returns account would be reduced, and they would recognize the returned inventory in a separate account, separate from the regular inventory. So returned inventory would be managed separately, and the entries are shown there. The refund liability, if they receive 2 back, would be $200, and their accounts payable would be $200, so they would owe them $200 refund on their $10,000 cash which they received in the past. Their returned inventory would be shown as $120, and their estimated inventory returns will go down to $120. And presumably when the time passed, the 30 days had passed, then if they still hadn't received that third item back, they would write off the estimated inventory returns, and the refund liability would be written off as well. And they would recognize the sales revenue at that time and the cost of goods sold at that time. Repurchase agreements. In some cases, companies enter into repurchase agreements, and that allows them to transfer an asset to a customer, but they have an obligation or right to repurchase the asset at a later date. The classic example here would be bookstores, which receive a supply of books from the publisher. If they don't sell the assets, they return the books to the publisher. In some cases, they tear off the front cover and are only obligated to send back the front cover of the textbook, or of the, not necessarily textbook, but any kind of book. They send back the front cover, which is cheaper for them to do, and for the publisher, it's cheaper for them to let the bookstore dispose of those assets. And it's kind of, if you go to a used bookstore and you see a bunch of books on sale which don't have their front covers, then they probably haven't been, the publisher probably hasn't been paid for those assets. But anyway, that's a bit of an aside. So that's an example of a repurchase agreement anyway. So the repurchase agreement allows them to transfer an asset to a customer, but they have an obligation or right to repurchase the asset at a later date. So in these situations, the question is whether the asset is the the vendor's asset or whether it is the customer's asset. So generally, companies report these transactions as a financing or borrowing against the value of the asset, and so the company has the obligation or right to repurchase the asset for an amount greater than or equal to its selling price, then the transaction is a financing transaction by the company. So they're actually borrowing money on the basis of the security of the assets transferred. Bill and hold arrangements is a contract under which an entity bills a customer for a product, but the entity retains physical possession of the product until it's transferred to the customer at some point in the future. Bill and hold sales result when the buyer is not yet ready to take delivery but does want to take title and accepts the billing. Arrangements such as a bill and hold transaction is an example where the economic substance of the transaction needs to be determined. With a bill and hold transaction, there may be a bona fide business reason for structuring a sale this way, such as lack of space at the purchaser's warehouse. So professional judgment must be exercised to ensure that a particular transaction meets the criteria necessary to be classified as a sale. Principal-agent relationships. In a principal-agent relationship, the principal's performance obligation is to provide goods or performance services for a customer. The agent's performance obligation is to arrange for the principal to provide these goods or services to the customer. And so there are two different performance obligations, and so the principal and the agent would recognize their performance of those obligations depending on their relative pieces of the contract. So the amounts collected on behalf of the principal are not the revenue of the agent. Standard example here would be like eBay, where eBay is only providing the service of connecting the purchaser with the principal who is selling the goods. The agent is only providing that service, and so they only record revenue for that service. When eBay first started up, they recorded revenue for all of the exchanges that occurred on the eBay site, and of course most of that revenue wasn't theirs, and so that gave rise to this this comment. Consignment sales. Consignment happens when the consignor receives goods which are still owned by the vendor. So a common principal-agent relationship is, as I said, the consignment relationship is a common principal-agent relationship. So in these cases, manufacturers or wholesalers deliver goods but retain title to the goods until they're sold. It's a specialized method of marketing, and certain types of products use this arrangement, and it's called consignment. So under this arrangement, the consignor is the one who ships merchandise to the consignee, who is to act as an agent for the consignor in selling the merchandise. So both the consignor and the consignee are interested in selling, the consignor to make a profit or develop a market, the consignee to make a commission on the sale. So the consignee accepts the merchandise and agrees to exercise due diligence in caring for and selling it. The consignee remits to the consignor cash received from the eventual customers after deducting a sales commission and any chargeable expenses. And so in consignment sales, the consignor uses a modified version of the point of sale basis of revenue recognition. So the consignor recognizes revenue only after receiving notification of the sale and the cash remittance from the consignee. The consignor carries the merchandise as inventory throughout the consignment, so it's still the consignor's inventory, so it's separately classified as inventory under consignment. The consignee does not record the merchandise as an asset on its books upon sale of the merchandise. The consignee has a liability for the net amount due to the consignor, and the consignor periodically receives from the consignee a report with the information about how much inventory is still around and what the sale price was and all that kind of stuff, right? So that's consignment. The key thing is that you don't actually sell it until later. So on the consignment books, the consignor ships the inventory to the consignee. They record a credit to finished goods inventory to reduce it, and a debit to inventory on consignment to increase it. When they pay the freight, they add that to the inventory on consignment and they pay the bill, so cash. Notification of the sale. When they receive notification of the sale, they set up the accounts receivable from the consignee and record the relevant expenses because they're going to have to pay them, and record the total as the consignment sales amount. The cost of goods sold is the reduction in the inventory on consignment, and so the cost there would include any freight out. Well, no, the cost would include the freight because it's already included in the inventory on consignment. Okay, so then when they receive the cash, they just simply record the cash and reduce the accounts receivable. On the consignee's books, they don't make an entry when they receive the shipment or when the freight is paid, because that's not their obligation. When they actually make the sale, they get cash and record the obligation to the consignor. And then when they make the remittance to the consignor, they would recognize the commission revenue and reduce the cash because they wrote a check to send the money to the consignor. Nearing the end here. Warranties. There are a couple of different kinds of warranties. There are warranties that say that the product meets agreed upon specifications in the contract at the time that the product is sold. So this type of warranty is included in the sales price of the company's product and is often referred to as an assurance type warranty. Warranties that provide an additional service beyond the assurance type warranty would be service type warranties, and is not included in the sales price of the product, and so as a consequence it would be recorded as a separate performance obligation. Companies do not record a separate performance obligation for assurance type warranties. This type of warranty is nothing more than a quality guarantee that the good or service is free from defects at the point of sale. These types of obligations should be expenses in the period that the goods are provided or services performed at the point of sale. In addition, the company should record a warranty liability. The estimated amount of the liability includes all the costs that the company will incur after sale due to the correction of defects or deficiencies required under the warranty provisions. In addition, companies sometimes provide customers with an option to purchase a warranty separately, and these service type warranties represent a separate service are an additional performance obligation. So as a result, the company should allocate a portion of the transaction price to this performance obligation. The company recognizes revenue in the period that the service type warranty is in effect. So basically they recognize the revenue over time, over the period in which the service type warranty is outstanding. Some companies receive payments from customers before they deliver the product or service, and upfront payments generally relate to the initiation, activation, or setup of a good or service to be performed or provided in the future. In most cases, these upfront payments are non-refundable. The company must determine whether these non-refundable advance payments are for products or services in the current period. So in most situations, these payments are for future delivery of products or services and should therefore not be recorded as revenue at the time of payment. Collectibility may be an issue. If it's probable that the transaction price will not be collected, this is an indication that the parties are not committed to their obligation, and as a result, one of the criteria for the existence of a contract is not met. So the collectibility is part of the criteria for the existence of a contract, and so if collectibility is not assured, collectibility would mean that revenue recognition would not be feasible. We would not recognize revenue if we can't be assured of collecting the amount. Anytime a company sells a product or performs a service on account, a possible collectibility issue occurs. Collectibility refers to a customer's credit risk, that is, the risk that a customer will be unable to pay the amount of consideration in accordance with the contract. So under the revenue guidance, as long as the contract exists, it's probable that the customer will pay. The amount recognized as revenue is not adjusted for customer credit risk. Companies will therefore report the revenue or the gross revenue without consideration of credit risk, and then they will present an allowance for any impairment due to bad debts, recognized initially and subsequently in accordance with the respective bad debt guidance. And impairment related to bad debts is reported as an operating expense in the income statement. Of course, that's not related to non-refundable upfront fees. Non-refundable upfront fees are generally recorded as unearned revenue because they represent an obligation to do something in the future. Finally, presentation on disclosure issues. Companies now use an asset-liability approach to recognize revenue. So the disclosure requirements for revenue recognition are designed to help financial statement users understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from the contracts with customers. So companies disclose qualitative and quantitative information about all of the following items: contracts with customers, significant judgments they've made, any assets recognized from costs incurred to fulfill a contract. Whoops, getting ahead of myself here. Let's take one step back here. Yes, let's look at this slide a little bit more detail. So when we use the asset liability approach, we recognize that there are contract assets and contract liabilities, and those must be recorded on the financial statements, on the balance sheet in particular. So two types of contract assets: unconditional rights to receive consideration and conditional rights to receive consideration. Unconditional rights to receive consideration would have been recorded as revenue. Conditional rights may have a contingent component to their rights to receive consideration, in which case you would have to make some kind of an estimate of the likelihood of receiving that consideration. A contract liability would be the company's obligation to transfer goods or services to a customer in the future for which the company has received consideration from a customer. So that would be kind of unearned revenue or a requirement to deliver some liability, some goods or services in the future. And we've discussed the idea of collectability. If collectability is not assured, then you wouldn't record the revenue because it doesn't meet the criteria of an enforceable contract. All right, finally, let's talk about IFRS versus ASPE. Some of the differences were highlighted in the text and the notes in our discussion today. Illustration 6-34 gives a summary of the key differences and similarities between revenue recognition issues. So you might want to review that. In terms of analysis, how we would use the revenue recognition standards to facilitate revenue analysis, we would focus essentially on trends. So we're looking at trends. And a revenue trend would be used as a measure of management performance and growth potential. So if we're increasing the amount of revenue, so increasing revenue, so sales growth would be a key component measured in terms of absolute values of growth increases or percentage growth compared to the previous period. It's possible that we could see biased reporting. So biased reporting is possible under both principle-based and rule-based accounting standards. It's often difficult to identify revenue misrepresentation in financial statements because note disclosure is often very general. The analyst looking at revenue must understand the business transactions, and any changes in the business model should be communicated to the reader of the financial statements. A company should not be entering into large and unusual transactions just to make the company's performance look better than it really is. So you want to identify cases where large and unusual transactions, which are very hard to value. So if you're thinking sort of historically, Enron's special purpose entities would be a good example of revenue being recognized, which is large and unusual in the pipeline business, which Enron was in. Looking ahead for the future, the International Accounting Standards Board has agreed to push back the mandatory adoption date for IFRS 15 to periods beginning on or after January 1st, 2018, which is past at this point. So earlier adoption was permitted, but now it's required to be used to recognize revenue. Long-term contracts, as we said, long-term contracts are discussed in some detail in Appendix 6-A, or Appendix 6A, and we're not going to go over them in a lot of detail. The journal entries are shown in that section of the textbook, and so we can take a minute to discuss it, I suppose. Unlike the earnings process relating to the sale of goods, where the critical event is normally delivery of the sales or goods, the focus in providing services is on performance of the service. So often the earnings process has numerous significant events as opposed to one critical event. Another exception to the general rule of recognizing revenue on delivery can occur regarding long-term construction projects. The accounting measurements associated with long-term construction projects are difficult because events and amounts must be monitored or estimated for a period of years. Two basic methods of accounting for long-term construction contracts are recognized by the accounting profession under ASPE. The percentage of completion contract, or the two methods are the percentage of completion method and the completed contract method. Under the percentage of completion method, revenue and gross profit are recognized each period based on the progress made to a specific point in time, the end of the fiscal year. And the completed contract method waits to recognize revenue and gross profit and recognizes them only when the contract is fully completed. Percentage of completion. Under the percentage of completion method, Revenue on long-term contracts is recognized as construction progresses. That is before we've delivered the final set of keys to open the front door. The accounting profession has for many years considered the percentage of completion method preferable when estimates of cost to complete and the extent of progress towards completion of the long-term contracts are reasonably reliable. The amount of revenue recognized in each accounting period is based on a percentage of the total revenue to be recognized in the contract. This percentage may be based on input measures such as costs incurred or labor hours worked, or on output measures such as tons produced, stories of a building completed, miles of highway completed, such things as that. So one of the popular measures used to determine the progress toward completion is cost, sometimes referred to as the cost-to-cost basis. Under this method, the percentage of completion is measured by comparing costs incurred to date with the most recent estimate of the total cost to complete the contract. So you would calculate that as follows. You take the revenues, the percentage complete times the estimated total revenue, minus the revenues recognized in the past, and that would be the amount of revenue you recognized in this period. So every period you do a calculation of the revenues to be recognized to date, and you would catch up to that amount of revenue. So if you've recognized revenue in the past years, you would deduct that from the total revenues to be recognized to date, and the difference, the remainder, would be what you would recognize this period. So revenues are calculated using the percentage that costs incurred bear to total estimated costs, and that gives you the percentage of revenues to be recognized to the point in time of the fiscal year end. With the earnings approach, no recognition is given to the contract when it's first entered into. A receivable is set up over the earnings period based on progress billings, and the account billings on construction in progress is offset against the construction in progress or construction in process account. And the construction in process account accumulates all the costs and profit recognized over the earnings period so that at the end of the contract, the balance in both accounts completely offsets each other, and the final entry is recorded to close both accounts. So they just reverse each other against each other. The completed contract method is also an earnings approach. Under the completed contract method, revenue, expenses, and gross profit are recognized when the contract is completed. The principal advantage of the completed contract method is that reported revenue is based on final results rather than on estimates regarding unperformed work. The major disadvantage is the distortion of earnings that may occur over the periods during which the work is done. The accounting entries made under the completed contract method are the same as those made under the percentage of completion method, with the notable exception of periodic income recognition. Note that the completed contract method is not allowed under IFRS. So under IFRS, any of the costs that had been incurred would be directly offset by revenue recognition for that amount. So you basically have zero profit, but you've recognized revenue and costs as the contract goes along. And that's all there is to revenue recognition. We're finished.